Of course, this is a black swan. No one could have predicted this was going to happen, but we do know that valuations are very high across most equity markets. Spreads are very tight across most credit markets. So I think that investors are wary and nervous generally. So the macro data has been pretty good. Monetary easing seems to be in place. So the underlying fundamentals are generally quite positive. But a lot of that has been factored into prices. So I don't think it needed much to knock markets back.
And you can certainly understand the jitters, right? Because when you try to qualify or quantify what kind of impact this could have on the markets, we don't really know, right? We've only got the SARS playbook, but that was all the way back in 2002, 2003. This could be, it could be much bigger, it could be much worse, or not at all. So extrapolating from there, would you say that any dips in the market would be a buying opportunity or just stay on the sidelines?
Well, I'd say it's a little early to tell at the moment. It seems that China is taking care of this problem very quickly, very effectively, much more, much stronger than and much faster than it did with the SARS outbreak. So from that perspective, assuming that this epidemic is in similar proportion, one would take a view that ultimately this will pass and ultimately the underlying fundamentals of the economies will be the key drivers of markets. But, you know, it's still early days.
It certainly is still early days. Do you feel that we have the level of response capability from both the monetary and the fiscal side to be able to counter any further negative downturn in the economy as a result of this or something else? I mean, the cogs have been really whirring, haven't they, at the central banks? And you could almost argue that they're starting to get out of bullets.
Yeah. No, I don't think we're there yet. You know, if we keep up the way we are, we will eventually get to that place. But I think where we stand right now, the Fed has scope to cut rates if it had to. It could restart QE if it needed to. The ECB is, of course, already in negative territory. But again, further QE, and there are a number of tools that are in place to stabilize economies in Europe that weren't in place back in 2007. So I think that central banks are still in a place where they can do things that would help stabilize if growth were to slow more quickly than expected. And also on the fiscal side, particularly in Europe, there is some scope for moderate further expansion, and in the UK as well.
You're actually quite sanguine, aren't you, on the outlook for the European growth prospects, and that it could surprise on the upside?
Well, that's right. Of course, my views were formed before this outbreak.
Right. And also partly thanks to the idea that China and all of its stimulus could start feeding through to Europe, but coronavirus might put a halt to that.
Well, that's exactly it. So my thesis is that Europe is very highly exposed to the industrial sector, the manufacturing sector, much more so than the U.S. And a lot of the slowdown that we saw last year was due to the slump in the global industrial cycle. And my view is that the pickup in China credit that we've seen over the past year will feed through global supply chains and will start to be reflected in PMIs and ultimately in a pickup in industrial growth in Europe and globally in 2020. Not a strong one, but a pickup, and that would lead to stronger growth in Europe. The question now is whether this situation in China and potentially globally has an impact on that. My instinct is it will be temporary, and that thesis still holds, that Europe will probably surprise on the upside in terms of growth in 2020.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.